Friends, welcome to video 18. In this video, I am going to talk about how the three financial statements that we discussed earlier, the balance sheet, statement of profit and loss, which is also called as income statement, and the third, cash flow statement, how they are interlinked with each other because they work together as a system. Friends, we have already discussed that the statement of profit and loss and cash flow statement capture data for the year. They are like a movie, they are like a video film. On the other hand, balance sheet shows the picture at a point of time. Typically, balance sheet is prepared and presented to stakeholders at the end of the year. In case of listed companies, it may be also presented at the end of a quarter, but speaking generally, balance sheet would be presented at the end of the year in a detailed manner after audit process. So now let us see how they work together as a system. Friends, on this slide, let us see how these three financial statements are interconnected. Let us say that there is a company which has been in existence for many years, and we had closed its books of accounts and published its financial statements at the end of the financial year, which ended on 31st of March 2017. So on that day, obviously, a balance sheet was prepared and published. The balance sheet, as we all know, captures the fundamental accounting equation, which is assets are equal to equity and liabilities, or vice versa. Now, of course, assets include bank balance, as we had discussed in one of the earlier videos. And similarly, when we are going to publish the financial statements for the year which had just ended, let us say on 31st March 2018, we would also be publishing a balance sheet on that day, which will have equity and liabilities and assets as on 31st March 2018. Now we obviously see a period of 1 year in between, which is 2017-18. Uh, Obviously, during this year, we earned income out of our core business as well as non-core activities. And to be able to deliver those services to our customers, we used a variety of resources, which obviously we call as expenses. The net of income and expenses is called as net profit, or in the US context as net income. Here, for simplicity, I have called it as profit. Now, this profit belongs to shareholders and naturally it adds to equities, but that is only after paying dividend to shareholders. So we can clearly see here that the profit adds to reserves or retained earnings after paying dividend. At the same time, during the year 2017-18, we also had inflow of money and outflow of money, isn't it? Which, as we discussed in one of the earlier videos, is captured on the cash flow statement. So the inflow minus outflow for the year, for whatever reason those inflows and outflows may be, whether it was operating, investing or financing, the net result is the net cash flow for the year for the year 2017-18, and that changes the bank balance. So whatever was the bank balance as on 31st March 2017, add to that the net cash flow, of course with the sign positive or negative as the case may be, and then we'll get the ending bank balance. So this is how we see that they're all interconnected with each other. Now, what we can say is that this is a close-knit system. Balance sheet 1, then a statement of P&L, cash flow statement, and balance sheet 2. Now, logically speaking, if we know three components of these four, we can derive the fourth one. Like quite often, the three components which are known are the starting balance sheet, the ending balance sheet, and the statement of P&L, and cash flow statement is often derived out of the balance 3, and that is how companies report that into their annual report, though obviously they have all the direct data in terms of what inflows they have received and what outflows have happened. They could easily report that, which can be called as direct method, but often they do not report it that way. They report in a very convoluted way, which is the indirect method, and that indirect method is that you know the other three, which is balance sheet 1, balance sheet 2, and the statement of P&L, and therefore you can derive the cash flow statement. But you could as well derive the ending balance sheet from balance sheet 1, statement of P&L, and cash flow statement, or you could even derive backwards balance sheet 1 if you knew the balance 3, because it's so closely knit and integrated. Now, what we see here is that there are three reasons because of which inflows happen: by collection of income, by raising equity or fresh debt, or by selling assets. And similarly, there are three reasons because of which outflows happen, which is to pay for expenses, to service equity and liabilities by way of paying dividend or paying interest or repaying the loans, or by way of acquisition of assets. So friends, we had already discussed three reasons for inflows and three reasons for outflows, but I'm just showing these arrows just to complete the conversation. Friends, now let us grapple with the question, which of these three financial statements provides continuity from year to year? Now, statement of profit and loss and cash flow statement capture data for the year, as we had already seen on the previous slide as well as in the separate discussion on those statements. So what happens is they are closed once the year is over. How are they closed? The net effect of statement of profit and loss is the profit, and that's captured into equity, as we already seen in the previous slide. Similarly, the cash flow statement, the net effect of the cash flow statement, the net cash flow changes the bank balance, and therefore even that effect is captured in the balance sheet. And then come next year, we'll start counting income, expenses, inflows and outflows all over again. And as we just discussed, they all fold up into the balance sheet eventually, because statement of P&L and cash flow statement provide their net effect, which lands into the balance sheet. So this closing balance sheet, the balance sheet as on 31st March 2018, as of our previous slide, actually provides the starting point for the financial year 2018-19. And thus the answer to the question which I have put on top of the slide, which financial statement provides continuity, the answer is, it is the balance sheet. So friends, do subscribe to the channel and use the playlist to view the exact videos in the Learning Finance series, because I keep on adding more videos in between too. So if you're subscribed, you'll anyway get to know them, but if you're not subscribed, look at the playlist so that you can easily find out all the videos and you can locate if there is any that you have missed. Thank you.